Welcome back, everyone. Today we're going to be talking about your different off-ramping abilities as well as some crypto taxes. And so before I get into this, and I do have a special guest here with me today, but I do want to say again, none of this on this channel is financial, legal, or otherwise advice, even though you just saw the thing before this video started. This is purely just for entertainment and educational purposes. If you are interested in tax advice, please reach out to a professional like Anthony Price or other people that are certified tax legal professionals. This is purely trying to gain understanding from my part and to entertain you. That being said, we're going to get into several questions today about, well, I'm going to come back to Anthony's here, but we had a video with Jake Claver who talked to us about how to off-ramp your crypto after you make your quote crypto fortune, right? And so depending upon how much money you make, it can be very difficult to get that money and back into the traditional system for you to spend it. And so I'm actually on a journey of trying to figure out this for myself, and I wanted to be able to share that with all of you. And Jake kindly recommended Anthony here to help us out with answering some of these questions. And so I'm super excited to have him on today. Just moving back to his site real quick. Anthony, thank you so much for joining us and being here today to answer all of my questions. So thank you.
Of course. Yeah. Thank you for having me. Looking forward to get back into these crypto conversations as the next cycle is about to ramp up.
Yep. Speaking of, we were talking about that a little off camera, but before we get into this, people may not be as familiar with you or your services. So can you just give us a short spiel about that?
Absolutely. My name is Anthony Price. I'm a CPA out of the state of Nevada, and I work with small business owners during the bear market. I work with a lot more crypto investors during the bull market. So I really service both, as I am both an entrepreneur and a crypto investor myself. So we help investors, entrepreneurs mitigate their taxes, whether that's capital gains, whether that's their business income. We help track their books, whether that's crypto accounting and for the degens or books for small businesses. So that's a little bit about what we do. I really specialize in tax planning, proactive tax planning.
Gotcha. Well, proactive is the, not my middle name, but it should be, as I'm trying to be there before things hit. So hopefully anyone watching this is trying to do the same. And so I
Yeah.
appreciate that about you and your services. I'll put the links to this website that we're looking at and all the links down in the description below, as well as the link to the video for Jake and his services for recommending and helping to facilitate this conversation. But that being said, let's get into why I asked you here, which is all of this. So I wanted to go into a couple different things today. One is when trying to off ramp, one of Jake's, or I think one of the services Jake provides is the ability to help set up an LLC and use a broker to be able to move funds into a bank account. And so I wanted to take a look at 3 scenarios today, and then about setting this up, as well as some other questions that over between the time of that video that we've created and now that I've come into that I'm wondering how taxes work. And so we're going to play a little bit of a game here in a second. But before I get into that, I want to ask this question about this one rule, and if you could help me out. So if you swap from one asset to another, let's say XRP to USD or XRP to RPR, which is another cryptocurrency. So either from crypto to USD or from crypto to crypto, is that a taxable event, and is that capital gains, or how does that actually work? And can you show me where we might find the answer to that in the taxes?
Absolutely. Yeah, this is one of the easier crypto related questions to answer because simply the answer is yes. When you swap from one asset to another, whether it's from crypto to USD or crypto to another cryptocurrency, you are triggering a capital gain or loss calculation.
Currently, right?
Currently, exactly.
Yeah.
So in the not in the Internal Revenue Code, of course, that was written far before crypto was created, but the Internal Revenue Service will subsequently release, notices, revenue rulings, et cetera. And so in a 2014 IRS notice, 2014-21, which we have right here, the IRS gave us, 6 whole pages for all of cryptocurrency regulations or lack thereof. And within there is a quick Q&A where I think it's question 6 there that says, if they exchange virtual currency for other property, is there a gain or loss? The answer is yes. Well, how is cryptocurrency taxed? It is property. So if you exchange virtual currency for other virtual currency, materially different, it is absolutely a gain or a loss. Yeah. So that one's black and white. If you're going from Bitcoin to Ethereum, if you're going from Bitcoin to USD, if you're going from, a top 5 market cap coin to, a bottom 5 zero worth coin, absolutely, that is without a doubt a taxable event.
So now besides like gas fees, setting those aside, or maybe you do want to address them, I'm not sure, but why is that the case? Because if I've got 500 USD worth in Bitcoin and I trade that for 500 USD value in XRP, at the time it's the exact same. So how are you making that gain or loss?
Yeah, well, I mean, if it was 500 for 500, you have a $500 basis, you have $500 sales price. Of course, there is no gain, but there needs to be some method of tracking the basis of this new asset. And that's why if it's a materially new asset, Bitcoin to XRP, there must be some record of basis transfer, which ultimately would be the record of the sale on your 8949, which records your capital transactions, ultimately ends up on your Schedule D. And so that's the justification, and that's why it would be necessary so that we can track the basis when you ultimately sell that next asset.
Okay. So knowing when that transaction happened and knowing the difference between that value and the next transaction is that basis.
Yeah, the cost basis of your currently owned asset, becomes, is the sales price of how much you exchange it for is the sales price. How much you bought it for, of course, is the cost basis. The equivalent US dollar fair market value amount of the asset you exchange into is ultimately the sales price of the asset you exchanged out of. So you take that Bitcoin that you bought for $500 and then you exchange it into $500 worth of XRP. Well, easy peasy, no gain, but there needs to be record of, okay, my cost basis of this Bitcoin was $500. My sales price of this Bitcoin was $500.
Okay.
That's what gets recorded. And then you can show within your records, if you were ever to be audited, well, I've got this XRP. It's now worth $5,000, $50,000, but ultimately I exchanged into it when I had this $500 worth of Bitcoin. Therefore, my basis is $500.
So I'm getting taxed on both the trade of the $500 as well as the trade of the $5,000.
That's what makes cryptocurrency taxes rather complex, because you may not have, US dollar cash out. You may not see the actual US dollar, benefit of the transactions you're making, but you may switch, Bitcoin you've held for 5 years. You don't think about the basis into some other investment that you want to go to the moon, and then it tanks, and you don't realize that you accidentally sold, Bitcoin you've been holding for 5 years with this almost zero basis because you bought it at, $1,000, and you sell it at the top, for $65,000, but then whatever you exchanged into goes to zero. Well, you still owe taxes on that $64,000 of appreciation that you incurred when you exchanged into this new altcoin. So that's absolutely a huge pain point that affected taxpayers negatively due to the 2021 bull run. I saw that hurt a lot of taxpayers.
Yep. It definitely seems like unfair taxation, but you don't make the laws. You're just here to help us understand them. So I appreciate that.
Yeah, I know.
I'm sure you're wanting to enforce new ones too. So
Totally. I mean, that's a couple different podcasts. Is the, the morality behind this stuff, the constitutionality behind this stuff versus how it's actually, executed in law. That's, what's kind of most important to me is, following the book, finding where, there's some interpretability within the book so that we can find our advantages. Where's the opportunities within the tax code? Because there's a lot of value hidden within the tax code for crypto investors. That's for sure.
Well, on my journey of mapping this out and trying to understand and be prepared, so I hope you'll help me understand this. But I feel like this is going to be the basis for a lot of this conversation. So I wanted to go ahead and find this and
Yeah.
figure out where this is said, and so that can be the basis for and maybe you can explain why this may be what we go into in the future may be an exception to this or what have you. So I
Mm,
appreciate you showing us
yeah.
this though.
Yeah, I
Um,
mean, this is one of the most important things to be aware of, that when you look back on it, it seems obvious, but when you're actually in your day-to-day, you're doing your trading or you're looking to make some cryptocurrency moves, it's very easily overlooked because you go, oh, I need to ape into this next project for 30 grand. I got this Bitcoin that I've been holding on for 10 years. I'm ready to move into this, this brand new project. You don't think about the capital gains you're incurring. Again, that is so extremely important when it comes to year-end tax planning, especially during the bull market. So that piece of advice is very, very, very valuable when we see the next bull market.
Okay. But now let's just say that people are because people might say this and like, oh, they might get afraid. And let's just before we get into the next part, let's set up another example. So let's say I'm Bob. I'm just getting into, and if you're Bob, hi Bob. But I'm Bob. I'm getting into crypto for the first time, and I want to go because I cover projects on the XRPL. I want to trade my XRP for this other crypto token. So I go from USD, I go buy some XRP on say Uphold because we like Uphold and they like XRP. So haha. We buy some XRP on Uphold, we send it to our Zum wallet. We use the Zum DEX to trade XRP for this other token. How many taxable events are in there based on what we're talking about here?
Well, it sounds like quite a few transfers, right? Because when you first purchase the cryptocurrency with US dollars, no transaction, no, capital gain or loss transaction that's happening. If you transfer it from one wallet to another, it doesn't change,
The value or anything.
ownership
Yeah.
or yeah. I mean, even if the value's fluctuated, if it's this exact same asset, then you're not incurring any kind of capital gain or loss calculation. So when you move it into this next wallet, no worries there. It's all about once you start to, get rid of that coin, exchange that coin, sell it for, whatever it may be, or if maybe you send it to a protocol and now you start making, staking income. Now that's a whole nother taxable event or chain of taxable events that we can certainly get into.
Okay, yeah, staking is I'm gonna add that to the end of the list here. So I don't know how long I've got you for
Beautiful.
here today, but I'll take advantage of
Let's
every
keep on
minute.
going.
So
Absolutely.
so this is going to be the next part where we're going to play kind of a game of let's pin the tail on the donkey and, figure out what's wrong with the donkey here. So
Mhm.
I have these three different scenarios. Scenario 1, 2, and 3. 3 is a hybrid of 1 and 2, and it's all dependent upon where people are starting in this conversation of trying to figure out off-ramping their wealth, right?
Mhm.
And so the questions I'm looking for each of these is what are the tax implications through the process, and what are the tax implications on the ways of spending the money afterwards? Because spending the money as an individual is probably going to be different from spending the money as a company. And in the first scenario, we're just an individual who we're going to go use the broker Jake was recommending, which is Caleb and Brown, and we're going to
Mhm.
send the funds, our XRP to there, and we're going to use our personal bank account. We're going to send that money from Caleb and Brown after we do the transaction of XRP to dollars to the Bank of America, and then that person is just going to go, spend the money, maybe use their debit card.
Mhm.
Um, what are the taxable events in this scenario?
The first step, when XRP is converted into US dollars.
Okay, so this is a taxable event right here.
Yep, exactly. So just generally good advice, whether it's individual, business, no matter how complicated your crypto situation may be, I'm going to recommend you use a crypto tax software. Coinly is a pretty simple, easy to use interface. There's a couple others out there. I tend to use Coinly with my client base. Connect all your accounts and track all this information. So especially if you're not a complicated trader, it's easy to track your crypto accounting, and then your CPA that may not even know much about crypto doesn't need to go in and do a bunch of manual fixes, right? Especially if it's just XRP to USD, that's a pretty easy calculation. Coinly with a K. Yeah, so just connecting all of your accounts, and they'll start importing all of your transactions through all the approved wallets. They have so many wallets that they can connect to, whether it's a DeFi wallet or whether they can create an API for one of the more centralized exchanges. They've got a lot of options for automatically importing all your transactions, and therefore it's a quick review over all your transactions. They've already been uploaded, and they're getting more and more accurate every single year. And then it makes it pretty easy to create reports, and CPAs should know what to do. At least a crypto savvy CPA is definitely going to know what to do with the reports that Coinly creates. So I highly recommend everybody use a crypto tax software like Coinly, like the others out there, CoinLedger, etc.
Okay.
So in this situation, it'd be pretty easy to prepare taxes, to track taxes for this, because if you're tracking your portfolio and you have XRP and then it's turned into US dollars, we'd need to have the basis of the XRP tracked to know what the cost basis is, but it's simple to calculate. All right, what's the sales price? That's half the equation.
Okay. So the taxable event would mainly be here, transferring the dollars to the bank. You're saying is not taxable. Transferring from, or sorry, using the money in the bank and spending it. Just saying using your debit card. I'm not sure if like other ways, but how will this be taxed? I mean, just normal sales tax, like.
It's really not. No sales tax, no income tax. Simply, you have a capital asset, you sell it, you have a gain, you're free to do with it whatever you like. So there's no additional tax implications related to this. It's like if you sold a stock, right? If you have, Tesla stock, you hold it in Fidelity. Fidelity would take the place of Caleb and Brown here. You sell the Tesla stock, you get $1,000, it goes into your bank account. Do you have any additional tax implications on the use of that $1,000? No, you don't. You only make a calculation of any potential tax liability upon the sale of the Tesla stock, nothing else.
Okay. And one of the I'm not sure if you're able to speak to this or not, or the clients you've had issues, but one of the reasons we're looking at this is because if we just go from the individual to the bank, the issue is that the exchange, if you're not using a broker, from what I understand, the bank will just flag it, and especially if it's still having to deal with crypto and like Uphold or something like that. Uphold limits you to like $70,000 a month or something of that nature, and then um so you might be dripping your fortune out monthly
Yeah.
at a different price depending, or if that broker sends the money to the bank, um there's all these holds and different stuff. So this is the reason we're going this route, and I'm trying to figure out,
Yeah.
okay, well, how do taxes, and what are the advantages of doing this as an individual versus doing this as a
Yeah.
company? And if
Yeah.
Jake, you're watching, if you have any, comments, or if I got something wrong, please put them in the comments below. But this is me learning
Yeah.
and sharing that with the community. So appreciate.
Absolutely. Yeah, I definitely appreciate that as well. I mean, banks can absolutely have issues if they see there's a lot of crypto activity going on, specifically for companies, right? I've got crypto company clients that can at times have trouble with their banking, because when banks see that, they think, oh, there could be some, sketchy stuff going on in terms of, asset management, even simple asset management, taking on too much risk. So banks do tend to shy away from cryptocurrency companies that can be a risk. Ultimately, not as much of a tax subject that I can comment on, but I do know that banks don't always love to see, a ton of crypto activity. So it's a worthwhile thing to research and, be prepared for.
Yep. And if anyone's has more thoughts, I'm sure they can reach out to Jake for it.
Yeah.
Scenario 2, though, is the scenario that he was helping me to set up. I think he tries to do something with, provide different solutions for all his clients, but this is the one that he was talking about. And you mentioned, a person has set up an LLC and is moving the money to a fund in
Mhm.
XRP and moving that to a broker and then to an LLC bank account.
Right.
So again, I guess the same tax thing hits here. Is that correct?
So yes is the short answer, and here's the explanation. A LLC, a single member LLC specifically, is considered a disregarded entity for tax purposes.
Okay.
Therefore, because it's disregarded, it has the exact same tax implications. So for asset protection, there are some things necessary in administratively to maintain the corporate veil, to maintain your asset protection. But when it comes to distributing assets out of the LLC, tax wise, it is really no different than distributing the assets in your individual name.
Okay. Interesting. So what about, like, I've heard besides an LLC, let's just change the scenario a second, because if this is going to be exactly the same, it doesn't really provide any huge difference in value. What if this was like,
Mm.
say, an S corp?
Mm. Well, the an S corp has something like the built-in gains tax, which is a relatively complicated tax where if you have a asset that was like highly appreciated that you put into the S corp and then you try to take it out of the S corp, there could be taxes on the appreciation that happened within the S corp. So the best advice, instead of going deep into the built-in gains tax, the best advice would be to say this: do not put your crypto holdings in an S corp. Absolutely do not put your crypto holdings in an S corp. If you have a business related to crypto making business income, you can put it in an S corp, but do not put your crypto assets into an S corp. Do not put really any assets that you're holding for investment into an S corp. There's no significant advantage to doing so.
Okay. Someone I was talking to was mentioning that there was a like you could some kind of rollover to someplace else to where like you wouldn't get taxed or something of that nature. If you moved it from the S corp to, say, another company or something like that. Um,
I'd be open to hearing the strategies that they're talking about.
okay.
In terms of capital gains tax mitigation, rolling a S corp. I mean, a C corp, qualified small business stock. If you were to sell a C corp, you can mitigate the capital gains upon the sale of that C corp by registering it as a qualified small business. I don't think that would be the strategy they're discussing. I can't say I know of some type of strategy that you can roll S corp into that will mitigate all of the capital gains. There could be some retirement account strategies you're talking about right now, and we could explore retirement, self-directed retirement account strategies for mitigating some amount of capital gains, or saving those cryptocurrencies for retirement. But in terms of entity structure helping mitigate capital gains, there's not a lot of there's not a lot there. There's
Okay.
trusts we could discuss. Absolutely, we can discuss trusts, but S corp, no, I would recommend against it. It's S corp's good for small businesses mitigating self-employment taxes.
Okay. Um, well, interesting. So if this is going to be the same answer, I guess this is going to be the same answer too, that's going to be mainly, oops, I can copy it, taxed here as
Mm,
well. And then,
mm,
oh, we forgot to go over this scenario though. So taxation after spending your money. So if I'm an LLC and I want to spend the money myself, do I need to distribute the money to myself through an LLC? Like, is it a monthly distribution? Like, or how do I get the money and spend it from the LLC if this is the route I want to go?
yeah. If it's a single member LLC, you're a sole proprietor, it is at will. So if you want to put more money into the LLC, you can do so. If you want to take more money out of the LLC, you can do so. In terms of asset protection, you don't want to disrespect the corporate veil. What does that mean? You're commingling personal and business funds. You want to maintain the corporate veil, which means you're not paying for your personal expenses out of your investment LLC, right?
Okay.
You're taking distributions out of your investment LLC, which goes into your personal accounts, and then you're paying for your personal expenses. That's the only shot you have for the LLC to actually provide any liability protection, is to, not miss your annual refilings, is to respect the corporate veil, which means you're not commingling your investments with your personal expenses.
Okay. So you do want to do a distribution, but the distributions are at will. Is that what I'm hearing?
Exactly.
Okay.
Yeah, it doesn't have to be, oh, I can only distribute to myself monthly. You really can distribute to yourself as much as necessary.
Okay. So, but you want to do that by doing a transfer to a checking account, or rather than like spending your company debit card, right? Because that pierces the corporate veil.
Exactly. Yeah. If you're going to
Okay.
go to a restaurant for a non-business related meal, or if you're going to go buy some clothes somewhere, you're not going to want to do it with the credit card of this LLC if it's for investment and you're not incurring an investment expense. You're going to want to do it out of your personal account, which means if you need funds in your personal account, you should do a transfer, a distribution from your business account, LLC, to your personal account.
Okay. And in doing some research, if I'm just using this company for investments, is it taxed differently?
No, because if it's a single member LLC, it's going to be disregarded. So it could provide some asset protection, but it will not create any different tax result.
Okay. So I thought I remember researching somewhere that if it was how do I say this? If you were strictly for investments, then it would be taxed differently somehow. So maybe I'm remembering it
So
wrong. So that's why I'm
yeah,
asking you.
I'm totally. So if there's, a business happening where you're making business income, if you're starting a mining operation, if you're doing something related to business, you can then exercise some active business tax strategies, creative deductions, start writing off your computer, your phone, all of that. But if it's simply investments, it's simply capital gains and losses, you're not a day trader, maybe we could talk about day trader status, then there are no business expenses you qualify to write off against your capital gains and losses.
Okay.
Of course, you can write off your selling expenses against your sale price, but you're not writing off, the computer you use to trade on, or your home office if you're only a, if you're not a day trader, which is
Okay.
an IRS actual status you apply for.
Gotcha. So the only real advantage of the company seems like is the liability to yourself, and keeping that corporate veil up is what I'm
Completely. And that's and
understanding.
that's that's the same from, businesses too. If you are a individual and you put your business into a single member LLC, it's taxed the exact same way. You have the opportunity to upgrade to a S corp, but it's taxed the same way. If you're an individual, you put your investments into an LLC, it's taxed the exact same way. The benefit of doing so is your asset protection. So if ever anything, God forbid, were to happen to yourself and you are facing a liability, or to happen to your business or your investments, you're facing a liability, or if you simply want privacy,
Yep.
that's the benefit of having an LLC. Also, potentially business credit for the business
Okay.
owners out there.
Gotcha. And of course extra miles on the business credit card or whatever have you. So yeah.
There we go. Big
Um,
fan.
so if this is going to be taxed the same way, and this just for everyone's, this is a person who transferred the XRP to a broker, and has cashed out the cash to the bank, and then has sent that, but now wants to create a company and put that cash as the creation of the LLC, instead of the crypto. Because whenever you create an LLC, right, you need to create a, what's funding that LLC. And so this is where we're using the cash rather than the crypto to fund the LLC. So is there any tax implications in the creation of the company from dollars or from crypto?
No, there are no significant tax implications. Of course, there's some information to note. I mean, whatever you capitalize your LLC with becomes your basis in that LLC to, deduct, right? You can't take business losses in excess of your basis. And so ultimately there are some tax tracking factors, but you're not incurring a taxable event. You're not creating taxable losses to write off against your other income just by transferring money from your personal account into your LLC, right? If it's for investments, then you buy investments. Once that money's in that LLC, you're still not incurring any taxable transactions until you start trading. If you're buying into a business and then you start incurring those business expenses, then those expenses are immediately allocated to you through the company. And so the initial capital contribution, the capitalization, is not a tax saving or tax creating event.
Okay. So let's replace this with XRP here real quick. And let's say we're funding the company with crypto. How do I need to store my crypto differently and to do this? And then how does it work for me getting taxed and the company getting taxed?
That's a great question.
Let's start with the storage. How do we need to
Yeah,
store it so that
so
it can be part of a company?
absolutely. So you want to have separate wallets. I mean, similar to how you would want to have your own business bank account, you would want to have your own business wallets. So when it's centralized exchange, it's easy because you open up an institutional account with Coinbase, not a big deal. When it's DeFi, it's a little bit different. And so you can capitalize the company by transfer from a personal DeFi wallet to a company DeFi wallet, or you could send it all into a centralized exchange wallet within the company's name and then go to your DeFi wallets owned by the company. Just don't commingle personal and business wallets is the best advice there for your custodianship. And then from there, you have essentially the exact same options as an individual for a business. So what's the best practices? Probably put it in a cold storage wallet. It's not a cold storage wallet that's joint for your personal and your business. It is strictly for your business.
Okay. So cold storage
So
for the
that
business.
is,
Got it.
yeah, so that is recommendations on how to custody the funds. Now, where it gets complicated is that you are contributing an asset that has a basis but a different fair market value. So that is why ultimately you could run into some complications when it comes to your taxes. So what you should do is you should have some proactive tracking of this information. Because if I've got Bitcoin that I bought at $10,000 and then I'm capitalizing a business with Bitcoin, the fair market value is $20,000. How much is that contribution worth? Is it worth the fair market value or is it worth the basis? So here's where it gets complicated, right? So I put it into the partnership and now I spend that $20,000 on startup expenses. Well, what happens there? I get distributed a $10,000 gain because of the discrepancy in basis, plus I get a $20,000 loss. Because that's ultimately what happened, right? We finally liquidated that capital gain, that $10,000 of appreciation, but it was within the partnership. And so the gain is calculated within the partnership, but also the fair market value of the incurred expenses, which is, of course, the fair market value of the Bitcoin I spent on the services at the time. That is ordinary business losses. So I have to recognize the $10,000 gain that I did have from when I bought it at 10,000 to when I redeemed it for 20,000, but I also get that $20,000 of business expenses that I then exchanged the capital asset for.
If they're actually business expenses, or if it is paying yourself a business expense.
Well, it can be, but that would be in an S corp, that would be in a C corp. I mean, you can run payroll out of a partnership, out of a single member LLC, but if you're simply distributing money to yourself, you can consider that paying yourself. No, that would not be a deduction you're taking on the return. That would be more tracking your capital accounts, where you could then distribute that out. Like if you don't exchange the XRP, if you have $10,000 of XRP that's worth $20,000, your basis is 10,000, your current fair market value is 20,000, you put it into a LLC and then you take it back out, you're not incurring taxable transactions. But if you put it into an LLC, you then sell it for USD or you exchange it for services in a business, now all of a sudden you have taxable transactions, right? If you take that XRP, you turn it into US dollars, and then you take out the US dollars, you incurred the whole $10,000 of capital gains right there.
Okay. And as long as those $10,000 are going towards legitimate business expenses, that's where, if you're starting a business or if you're going to use your crypto to start a business, then that's probably a good way around it. But if you're just trying to spend money to spend money, maybe not.
Yeah,
but anyways,
exactly.
this helps, and I feel like people, if you have questions, please, for this particular part, I may not be able to help you with any of these. I invite you to reach out to Anthony. I'll make sure to put his Twitter and stuff in the description below. So please take a look there. And then of course, spending it from a company perspective is the same way as above, right? Talk about distributions to yourself at will if it's a single member LLC.
Yeah.
So
Which a single member LLC is the only entity you should be looking at if you're an individual that's investing just for his or herself, right?
okay.
Is extremely, extremely unlikely that I would ever recommend a S corp or a C corp. I'm not going to say, never, because the answer in taxation is almost always, it depends.
Depends, yeah.
But in the vast, vast majority of cases, you're not going to want anything other than a single member LLC, disregarded entity for your cryptocurrency, because there's no benefit to an S corp or a C corp in the vast majority of cases. But there is with C corps and S corps additional administrative requirements that cost money and time, and could lead to more taxes than you want, not less taxes. And so don't complicate things. Keep it simple. Individual name or single member LLC for its benefits, which is asset protection, potentially privacy, and potentially business credit. So that's what an LLC is for. But when it comes to taxes, it's not going to materially change the taxes.
Gotcha. Okay, well, I feel like this helps me understand those advantages better, and so I really appreciate that. So whenever you make your crypto fortune, the things I take away out of this, and Anthony, correct me if I'm wrong, is don't switch from tokens to anything else as few times as you have to, and make sure that you are using Coinly or another tax software that will help you track stuff up before you start moving things around, right?
Yes, exactly. I can't reiterate that enough for the crypto investors, especially those that have been investing for quite a while, because you very well could have very, very low basis on the Bitcoin you've been holding since 2014 and selling it or exchanging it for an altcoin. That's going to create a big, big tax liability that you're unexpected, or you're stoked. All right, I just rode this altcoin up from, $10 to now it's $200, and it's time for me to take my profits. Well, understand what kind of a tax liability that's going to come with, right? And it would be a good idea to save some money, maybe put it in a stable coin, put it into USD, to pay those taxes that you're going to be faced with, and do some end of year planning. When you track your Coinly, it's pretty easy to do that end of year planning, because you can hop into it, make sure there's no significant errors, and go, all right, So I'm at a $50,000 gain right now, but I've got $60,000 in unrealized losses. All I got to do is sell or exchange into a new crypto with those unrealized losses. And now, boom, I just wiped out my entire tax bill because I was proactive in understanding where I'm at with my crypto portfolio for the year. If people would have done that in 2021, the end of the year, there would have been a lot, 5, 6, 7 figures in taxes saved for many of my clients. And so they were new in 2022 clients. Otherwise, we'd have made sure that happened.
Well,
So
I might
I
have to
can't
do just a small video on that later, but I'll have you back for that.
awesome.
But let's get to the bonus round of staking and or staking and other questions, put that way.
Yeah.
So in my experience, in my limited experience, and I'm I've been around here a while, there's two different types of staking. One requires you, which is I guess more Ethereum based, where you put your tokens in another liquidity pool or something, and you are literally, you put your coins are no longer in your wallet, they are in this other place and they are being staked for a return. And so what are the tax implications for that form of staking, for non-custodial staking, if you will?
Well, I'd like to preface the staking tax questions topic with saying that even the IRS isn't 100% sure what
Oh,
they
it's
want to
great.
do yet. And so,
Whatever they feel like the day is, huh? They can get money from you.
yeah. I mean, there was a court case preliminarily. It doesn't create exact precedent in terms of how staking income is taxed, but a taxpayer went to court with the IRS to say, are you sure that staking is always taxed as ordinary income upon its availability for claim? Or is staking taxed upon that ultimate claiming of the funds, putting it back into your wallet? Because the IRS argued that, well, no, it's taxable once it's available for you to take it. You could take it out of the wallet at any time. So you technically do have, control over the funds. And the taxpayer said, no, I would disagree with that. I think it's not taxable income until which time I actually do put it into my wallet for use. And the taxpayer did come out victorious. And so that is some momentum for the side that staking income may not be required to be taxed until which time it's ultimately claimed, which would be great because we saw these rebasing DAOs, a year or two ago that were spitting out staking income, every 5 minutes, every 8 hours, whatever. And so you've got, 5,000 transactions in a year just on one, staking project. So that would be great. That is something the IRS is trying to figure out. The SEC is trying to figure out. All of the US and world governments are trying to figure out, how do we regulate cryptocurrency? How do we create some standard rules for how this stuff should be taxed? And it's a big project. And that's why you would have expected, or at least I would have expected it to be out by now. But ultimately, it's still in process. So that will change, right? Some of these answers may change over time. But right now, how is staking taxed? Ultimately, it's taxed as ordinary income, similar to interest or a dividend, right? It's taxed as portfolio income, ordinary income. So not capital gains income, but at your ordinary income tax rates.
Okay. I can't find my XRP wallet icon that I had in here that I always use. Let me just find. Let's see, Google X. Okay, this works. I'll take that if it'll pop up for me. There we go. All right. So now we've talked about essentially the moving the XRP out into staking, or not that XRP doesn't stake, by the way. So I guess I should have chose Ethereum, but now we're gonna talk about soft staking, which is where I don't, if I had StakeX, I'd put them here, but essentially, I guess imagine StakeX's icon here, and they're soft staking. So what that means is they're kind of a rewards platform to where they will read your, are you familiar with StakeX, by the way?
I can't say I am, no.
Okay. I just did a video with them. They just recently did a update to their platform, but what they do is you can buy some of the StakeX token with your XRP, And based on the amount of StakeX token you have in your wallet and the other token, it kind of works similar to a liquidity pool, but you hold your tokens. And
Mhm.
so what they do is you give read access to the site. The site reads how much of an XRP value you have in the token of
Mhm.
StakeX and in this other token. And if based on the, I guess, the highest value you have, between the two, you get a certain amount of rewards. And so this is a very interesting use case that, I mean, I've been gaining passive income through them for, I guess, over the last year. And, I'm just essentially getting airdropped whatever token I'm soft staking for
Mhm. Yeah,
over the last year, just daily to my wallets. And so it's a
gotcha.
great method for passive income, but I have access to the funds all the time. So how does that work?
So probably an easy answer, right? You have access to the funds the whole time. As soon as you receive it, taxable event, ordinary income, easy as that. Hopefully you're not receiving, 5, 10, 20 a day, because that's going to be a long report that Coinly
Yeah,
will have to print off.
I
But
am.
that's simply how it's taxed. Yeah, that's the kind of stuff where, they're trying to figure out, man, this stuff is messy. This stuff is hard to track. So, maybe something will come out and materially it'll change, or the tax softwares will catch up to where it's not such a challenge to track that volume. But ultimately, it is what it is. Taxable event every time you receive a new payout, ordinary income.
Really interesting. It's all based on the value that you got it at, right?
Fair market value in US dollars. Yeah.
So it could
That's
be a
another
fraction.
challenge right there.
It could be a couple
Sorry to cut
cents,
you
and
off.
they're like, okay, well, I
Yeah.
still want my half. IRS is like, man, I want my half a penny, man. Like, come on.
Yeah, exactly.
Oh my
Exactly. I mean, that's
gosh.
challenging because, we're used to stocks that don't have such significant fluctuations daily.
Or
Whereas
frequency.
crypto
Like,
frequency, exactly, you can trade it whenever. The fluctuations are so great that, all right, what day did you trade it on? It's like, all right, well, I could have had a 10, 15, 100% fluctuation just on that day. And so reporting the actual value, you know it can be challenging sometimes, based on the reporting standards of old with the IRS to, the data that we now have today and the frequency of transactions.
yeah, I mean, logically, I would think that on, like, just as in, staking, that, I've received something, but it doesn't mean I've cashed it out. It doesn't mean that, like, the value has hit US dollars. And so
Yeah.
all the logic and what other people have told me until yourself um is that unless I cash it out, like, the IRS isn't gonna come down on me if I receive pennies of passive income a day that could, let's say, by the time that I cash it out, which is where I think that the IRS would be interested, and I'm sure that they are,
Mm.
let's say that one of the cryptos I'm passively drip takes off, all of a sudden hits 50 cents. It's a 50x for me, and I've been receiving, 1,000 of the token for, daily for whatever reason. And
Yeah.
so that's just nuts. I
Yeah.
mean,
Yeah, I mean, that's an issue that hopefully there will be some clarity. I, off a hunch, expect, some kind of regulatory clarity, in short, over the next couple, months to year. Who
okay.
knows though? You
Well,
never know with
hopefully
the
we'll have you
government.
back, and this will all be cleared up, and we'll be like, hey, remember that thing that was horrible? It's not here anymore, But
Exactly. Exactly.
oh man. But yeah, so StakeX, I'm receiving, like, I think between 9 and 13 tokens depending upon votes. So which
Mhm.
also goes into this next one
Yeah.
of I asked you about Reaper before the video. I know you're not too familiar with it, but
Mhm.
there are three different tokens that provide several different forms of passive income.
Mhm.
One provides you XRP directly to you. The other provides between 9 and 15 other tokens. And the other provides the other two tokens to you. So it's kind of a recursive passive income stream. But you're saying
Yeah.
all of those that hit your wallet every 2 weeks from this is also um Is taxed the same way?
Good old ordinary income. Yeah, airdrops, whether you intended to receive it or not, it is ordinary income. I shared an article with you, nicely written article. It simply is income when you airdrop all that. That's a fun one where as you receive it, all 15 coins, you need to recognize it as ordinary income. This is why you got to be using the crypto tax software. Simple answer, yes, income, ordinary
Okay.
income.
All right. Man, I'm gonna be putting it through its paces then
Yeah,
over the
exactly.
all the transactions. I hope Coinly can keep up. But
No
I'll put
kidding.
this in the link in the description below. Okay. So next, let's talk about let's say this is in the a an LLC wallet and it's used for, let's say all of a sudden I put Reaper, Ascension, and Arc for the example in this because I don't know of any other coin that does these things. I put them in a LLC wallet, use them to fund the LLC. I keep them in a separate wallet. All of a sudden, the LLC is receiving all this passive income. How does that work?
Hmm.
Same way?
Same way, same way. Yeah, easy answer.
Okay.
Yep, same way. When you're receiving the staking income or airdrop income, ordinary income, if that income that you recognize as ordinary income becomes your basis in the received cryptocurrency. For example, if you receive 10 XRP and they're worth $1 each, right? At the time you receive the airdropped XRP, your basis is $1 per XRP, right? So then if you sell it the next month for $2 per XRP, you recognize a $1 capital gain, right? So you're paying ordinary income taxes on $1 when you get airdropped to XRP.
Okay.
You're paying capital gains taxes on $1 when you ultimately sell it for $2. So that's the only thing that I would add to that protocol, but otherwise it's same as previous answers.
Okay. So there's no super advantage to getting the passive income in an LLC. And for instance, I was also told that if I make changes to the I forget the term, but whatever the funds are used to create the LLC, like I needed to have them what's the word? Notarized? I think it's notarized and into any changes. I mean, if I'm receiving passive income, that becomes really impossible on a daily basis to keep up with. So it does the keeping the wallet separate and the corporate veil mitigate the need for a notary to sign anything in regards to changing the what do you call it? Uh the funds that create the LLC or what have you?
You really only should need a notary for material changes to the LLC, like, maybe an operating agreement amendment, or like change in partnerships or change in some filing with like the state governments. Other
Okay.
than that, you really shouldn't need, notarization or very formal documentation, like government formal documentation for much. Yeah, so that shouldn't be an issue.
Okay. Because I'm just like, man, that's a lot of notary fees for having to put it in an LLC if that's the case. So
No kidding.
I'm just like,
Yeah,
it
it
wouldn't make
shouldn't.
much sense, but I figure I'd ask.
Yeah.
So that's the Reaper questions and the airdrops, I guess, is what all of these kind of cover. The next is bot trading. So there are some couple cool opportunities that I've found on the XRPL that involve bots. And
Mhm.
so, like, if I'm getting taxed and if we're doing, hundreds of trades a minute, like based on that rule we just talked about, that like every trade is taxable, or how does that work? Like, is that the same thing? Do I need to hook up Coinly to the bot? Like, how, what do I need to do?
That can be a fun one. Yeah, that can be a lot. There's plenty of potential transactions when it comes to bot trading. I mean, if that thing's trading 100 times a day for you, 10 times a day, think about how many transactions are going through it. And of course, those transactions are happening on your behalf, and therefore they are all, taxable transactions. And so there should be some plan for tracking all of these transactions up front instead of after the fact. So get on one of these crypto tax softwares as quickly as possible. You may need something that can handle way more transactions than even Coinly, depending on how many transactions you're going into. How is it taxed? Well, it depends on what you're trading. If it's just normal, day and swing trading, it's going to be taxed as capital gains. If you're trading, futures, potentially it's eligible for the advantages, Section 1256 futures tax treatment, but I don't want to go too much into that, because
we're staying
it's
crypto. I'm just
mainly
trying
for
to do like,
equities. Yeah,
if I want to
exactly.
do XRP to RPR or XRP
Yeah,
to Treasury or whatever.
normal capital gains, and it's probably more of a pain to track because there's likely a lot more volume of transactions, but try to keep it into, one wallet that is importable to a crypto tax software. And, just be aware of your P&L for the year. Hey, I'm up $20,000 on my bot trader. I have an unrealized loss on a long-term position of $25,000. Why don't I cut $20,000 worth of losses, cut out my taxes on that $20,000 of income?
Okay, so you're saying it's not so much about the individual trade and being taxed on the individual, but it's all going to even out at the end in terms of like, this is your. So I'm trying to figure out, because spot trading is new to me, but I am interested in it. I know a lot of my viewership probably is too, as some of the people in the XRPL, I think Swiss Tech makes it really easy. And I'm trying to look more into that too. But how do we? I'm trying to figure out if we have all the crypto taxes tracked. I just don't want to be
Mhm.
like, yeah, I gained 20K, but all of a
Yeah.
sudden I have to pay 40K in taxes somehow. Like that's the situation I'm trying to avoid, I guess. So
Yeah, yeah. Well, it just depends on your positions, right? So bot trading is automated trading. Preferably you'd also have some system for automated tracking, and
yeah,
therefore it's pretty
what's the
dang
blockchain? But
easy.
yeah.
Yeah, all right. Well, it's then converting that into, understandable data for the tax return. And so hopefully there's a solution available, with the bots that you're using, with the platform that you're using. Many of them do have those types of solutions. Where it's the same type of taxation as if were trading all of it yourself. Usually most of the positions are going to be entered and exited, in the short-term time frame, a year or less, and therefore,
Or a
there's
second. Yeah.
not, or a second, exactly. So there's not too much to be concerned about or worried about in terms of, your you know long-term versus short-term strategy. um, yeah, it's really just your gain and loss. It's your gain and loss. If all of your transactions are short term, and you don't have many positions that are still open, it's all about your gain and loss. Because there's capital gains that are realized, there's capital gains that are unrealized. If there are no open positions and it's all short term, all you need to know is your gain and loss. In terms of calculating your tax liability, that's all you need to know. What's your gain and loss? Because
Okay.
it's all short term, and because there's no open positions that represent unrealized gains or losses, then in that case, that's all you need to worry about.
So this is going to be likely short-term capital gains, which is what percentage of the profit or of the
Your
trade?
ordinary your ordinary income tax rates, which there's 7 different brackets depending on your other income, 0 to 37%.
Okay. So, but let's just say the maximum it could be is 37%, you said?
Yeah, I mean there are portfolio there are net investment income taxes. So if you're over $250,000 of investment income, you could have an additional 3.8% applied.
Okay. So let's just say 40% to call it even. Um, like if I get into bot trading and I'm like a lot richer than I am to get into this, I could be looking at upwards of about just over or just under half of the gains being taxable in the worst case scenario.
Hopefully you don't live in California.
Yeah, I don't. So why? What's up with that?
13% taxes.
Oh,
On
okay.
top of that, you're over 50% of your taxes to California. If you're making a lot of money on bot trading, you're in the top tax bracket, you live in California, could be, 54% taxes to the government.
Wow. Okay.
So
So
fun.
how we're gonna keep track is Coinly up to, I guess, I mean, unless you're in California, it's just over 50%, which is crazy. I don't think any of us who are getting into it are there, but we're looking at either way, short-term capital gains for bot trading, and then actions to be prepared for at the end of the year. Call Anthony and make sure you have Coinly running, and it'll get us helped out.
Exactly.
Okay.
Yeah, have your Coinly running. Just plan. Everybody's situation is differently. Do you do mining? Do you do staking? Do you do simply trading? Are you a day trader? I mean, if you've got good cash flow, or you've got quite a bit of income or trading activity, it's a good idea to consult with a tax advisor proactively upfront, so you get your plan, and then you just simply follow that plan for taxes. We'll want to know, all right, are there any potential tax strategies related to my investment strategy, staking, mining, capital gains? How best should I track depending on my type of trading? Do I need to focus on a tax software that handles extremely high volumes of transactions, or can I do one that is a little bit easier to use, right? End of year tax planning. Okay, what's my current capital gains or loss balance? Is there any strategies that I could implement? Stuff like that is very important to, consult with an advisor, and ultimately have a plan for. That's going to give you the most value, at least having an hour consultation with a tax preparer, or having ongoing advice.
Gotcha. Well, speaking of that, let's talk about, if someone is looking to set up one of these scenarios that we've talked about, they're in these different scenarios. I'm not sure if you have or want to talk about your rates or what services you provide. Let's say, we're already paying for Coinly. Coinly already has, it's I don't even know where its prices are on here. But
Yeah, it's like minimum. I think if it's under 1,000 transactions, it might be free. 1,000 to 3,000, like $79. 3,000 to 10,000, like 179, and then above that, it's like 279. If I
yeah, I'm
remember
probably
correctly.
hitting the 279 myself for all those I don't know if to say stupid. I'm very thankful for them, but all the airdrops that I'm getting, I kind of wish they could get
Mm-hmm.
consolidated sometimes.
Mm-hmm.
But
Totally.
might need to talk about those services or talk to those services about that. But yeah, very,
Yeah.
very interesting. But your services, what like how much do you
So
charge,
for
or is it what?
uh for crypto investors, usually the type of transaction we're going to have is consulting. We'll do hourly consulting. We'll go into all of these considerations I brought up. $300 for an hour worth of consulting. If we're
Okay.
going to be compiling your crypto tax report, that starts at $500, goes up from there depending on the complexity and the level of degen that you may or may not be. If we're going to do a full-on tax plan, or tax strategy for a crypto entrepreneur, it's going to be just completely based on their specific circumstances. So those two right there are mainly the types of services we provide, and then simple tax filing starts at $500.
Okay. Simple tax filings start at $500, but would
Yeah,
you
I mean
say
a
a crypto
Schedule
person
D.
is simple, or like, I don't know.
It depends. It depends. Usually they are. If it's like, hey, I got my Coinlink report ready, I need you to throw on the Schedule D, and we got a little bit of, ordinary staking income. Yeah, it's a simple return. We don't have too much to do. But if it's like, I need you to fix my Coinly, I need you to do my return. Oh yeah, I bought these miners, I want to depreciate them. Now we got a Schedule C in the mix. We've got some Coinly cleanup to do. It's going to be up than $500. But if the crypto calculations and the accounting is good, it'll be right at that number.
Okay. Well, sometimes Coinly and these other tax softwares don't always bring in the prices to some of these altcoins. Wanted to know your take, or what you have what are your thoughts on that, and what do you tell people
Yeah.
sometimes?
Well, number one, they're getting better. Number two, they've significantly, yeah, I mean, that's basically was going to reiterate. They've significantly reduced the amount of coins that they can't import. Sometimes there's some manual fixing that's required. So do a calculation whether you should pay a company to be doing it for you or whether you can go in there and manually fix it yourself. Yeah, I mean, those are the two main things, because I highly recommend having an accurate cryptocurrency accounting. So there are ways to fix those issues within the crypto tax offers.
Okay, so how much are services to manually go in and fix? Let's say that like, because I'm in like 40 different positions. I went in small into a lot of different ones, and so like some, I'm not sure how long. Well, I guess it's the year, right? So, I mean, you're talking about a year long positionings on things, and if I'm getting all these little airdrops and one coin doesn't show up, that's a year's worth of daily hits and transactions. How much would do you think that would be to fix?
Man, I mean, that's really tough. If I'm going in there and I'm fixing it myself, I'm going to charge my hourly rate of 300 an hour. If it's something
Wow.
that,
Okay.
staff members are capable of, then I'll delegate it to staff members, at a significantly reduced rate, 100, $125 an hour. If there are other ways to fix it as well outside of the software, then we could certainly do that. I mean, we're no strangers to doing manual calculations of, here's the values, here's the quantity, boom, that's how much you should be recognizing as ordinary income. Sometimes just simply using Excel is going to give us more accurate calculations and accountings for these transactions. So sometimes we'll solve it that way. All this stuff is so dependent on the specific circumstances that it's hard to say exactly how much something's going to cost without being able to look under the hood.
I hear you. We're just so early that like there's all these nuances and all of these, even though they're getting better.
Yeah.
I submitted my taxes last year and I was like, I think everything looked good to me, but I'm
Yeah.
always, it'd be great to have someone to go to, and now I feel like I know someone to submit to that, I can trust to do those things. So
Yeah.
extremely cool. Do you have
Yeah.
any last, I guess, words for the community, as you've answered all my questions? And I really
Mhm.
appreciate your time, by the way.
Yeah, no problem. Much appreciated. Thanks for having me on. That's everything. I would only reiterate what I said in the past. Tax loss harvesting. If you're going to face significant capital gains, be ready to mitigate those capital gains. Know where your positions are at before the end of the year so you can do the tax loss harvesting. Consult with a tax advisor that's familiar with cryptocurrency. And if you want to find me, AnthonyPriceCPA.com, Anthony Price CPA on Twitter. More than happy to help.
Awesome. Well, thank you so much, Anthony. Again, I don't know if I'll be able to help anyone in the comments below. If you have questions for me, happy to answer. But please reach out to Anthony, and always reach out to a tax, legal, or investment advisor. This is not any of those things. I'm purely here for entertainment and educational purposes. But thank you so much, Anthony. I'm JTXRP. Just make sure to smash that like button, and we're out.